accelerated in December. The unwelcome but anticipated blip is unlikely to derail further interest rate cuts from the European Central Bank, though. Inflation in the 20 nations sharing the euro picked up to 2.4% last month from 2.2% in November, in line with expectations. It was lifted by more expensive energy and stubbornly high services costs. Inflation has been oscillating just above the ECB's 2% target recently, and data over the next few months could remain choppy. But the overall trend is expected to point downwards, with the ECB's goal likely to be hit sometime in the second half of the year. The central bank cut interest rates 4 times last year and said its target is now within sight. More policy easing is coming, although the speed and timing remain subject to debate. Price growth excluding volatile food and energy held at 2.7%, and the closely watched services component, the single biggest item in the consumer price basket, accelerated to 4% from 3.9%. A strong dollar in recent weeks has been making imports of key commodities more expensive, and that's feeding through to prices via more expensive energy, including car fuel. The dollar could rise even more if the new US administration implements its trade tariff proposals.
Shell warned of a weaker fourth quarter on Wednesday. The energy giant cut its liquefied natural gas production outlook for the period. It also said oil and gas trading results are expected to be significantly lower than in the previous 3 months. Shell further warned it would take $1.5 billion to $3 billion of non-cash post-tax impairments. That includes up to $1.2 billion in its renewables division. Shell last month said it was stepping back from new offshore wind investments. It further said it would split its power division following a major review of the business. It's part of CEO Wael Sawan's drive to focus on the company's most profitable parts. The world's largest LNG trader said trading results for the division in the fourth quarter would be significantly lower than in the previous 3 months. It blamed the expiry of hedging contracts Shell took 3 years ago. That was aimed at protecting itself against a possible loss of Russian production following the invasion of Ukraine. Trading in its chemicals and oil products division was also expected to be significantly down quarter on quarter due to lower seasonal demand. Wednesday's update comes ahead of full-year results due out at the end of January.
U.S. stocks tumbled on Tuesday after upbeat economic data raised concerns that a rebound in inflation could slow the pace of interest rate cuts from the Federal Reserve. The Dow lost more than 0.4%, the S&P 500 shed more than 1%, and the Nasdaq dropped nearly 1.9%. Stocks gave up early gains after a Labor Department report showed job openings unexpectedly increased in November. And services sector activity accelerated in December, with a measure tracking input prices surging to a near 2-year high. Both reports helped push back expectations on when the Fed might deliver its first rate cut this year, said Rob Hayworth, Senior Investment Strategy Director at U.S. Bank Asset Management Group.
Stocks today are really selling off because we're seeing a much more robust labor market. Job openings above 8 million for the first time since May. So it's not an easing labor market. It remains a very strong labor market. Plus, we saw the services ISM number pick up and tick a little bit higher. So it looks like the Fed has more concerns when it comes to inflation and robust economic growth. And that pushed interest rates higher and kind of pushed down that equity market as people are concerned that we may not get as many cuts this year as we were expecting, which is already quite low at maybe 2 for the full year. And now it's maybe 1.
Benchmark 10-year Treasury yields hit an 8-month high. Higher yields pushed technology sector stocks lower by about 2.4%. Shares of AI bellwether NVIDIA fell more than 6%. Tesla shares fell 4% after B of A Global Research downgraded the stock to neutral from buy. On the flip side, shares of Micron Technology rose about 2.7% after NVIDIA boss Jensen Huang said the chipmaker was providing memory for NVIDIA's new Blackwell gaming chips.
Samsung is showing off its smart home gear at the CES Tech Fest in Las Vegas this week. That includes an AI-powered fridge that can tell if you're short on milk and write you a shopping list. But right now the outlook for the South Korean giant isn't so bright, and chips are the problem. On Wednesday, Samsung gave a fourth quarter profit estimate that fell far short of analyst expectations. It predicted an operating profit of just under $4.5 billion for the 3 months to the end of December, approaching $1 billion less than markets expected. The firm said it faced slowing demand for memory chips used in PCs and phones. Its earnings also face a dent from rising research and development costs and investments in manufacturing capacity. Meanwhile, it's lagging local rival SK Hynix in the battle to supply high-end processors for AI. Speaking at CES this week, Nvidia boss Jensen Huang said Samsung needed to engineer a new design to supply so-called high-bandwidth memory chips to his firm. However, he said the company was working fast and could do it. Wednesday's profit outlook from Samsung saw no update on that. Back in October, it issued a rare apology for a disappointing performance in the third quarter, but said it was making progress on supplying Nvidia. Samsung shares were up around 3% in morning trade as investors focused on the encouraging words from Huang.